Welcome back to the show. To talk about China and the U.S. economy, Peter Schiff is with us. Peter is the CEO of Euro-Pacific Capital and host of the Peter Schiff Show. Over the weekend, we learned China would likely be green-lighted for membership in the IMF's special drawing rights currency basket. I first asked Peter if this would really make much of a difference economically, or if it's more about Chinese pride of having made it into this exclusive list. Here's what he had to say.
Well, I don't think it's going to have an immediate impact, but I think it is a step in the direction in which China has been headed, and that is to make the yuan a reserve currency and ultimately potentially to be a replacement for the U.S. dollar, especially if they have the good sense to back up their currency with their enormous gold reserves, which I think China is deliberately underreporting, and I think they are accumulating more and more gold quietly and maybe secretly, because I do think that ultimately that is their intention, to have a gold-backed yuan become the predominant currency in the world.
Yeah, I'm glad you mentioned the immediate impact, because traders are seemingly not yet convinced that this is going to happen, maybe. The yuan fell to an intraday low on Monday, the first day of trading since the news broke. Shouldn't we be seeing some kind of short-term bullishness right now? What's going on here?
Well, I think everything is being clouded by the dollar bubble, dollar mania, and now the most recent events in Europe. The tragic shootings in France are causing more people to believe that there'll be even more cheap money policies, more quantitative easing in Europe. We know that Japan has just slipped back into recession. Who didn't see that coming? And so this has also got the dollar rallying once again, and that's seeking to depress other currencies, including gold. And so in this environment, it's really hard to see any currencies making some headway. But I do think that when the dollar bubble bursts and the air starts to come out, this is going to be something that helps contribute to the appeal of the yuan as it ultimately rises significantly against the U.S. dollar.
Okay, that's a fair point. We'll keep our eye on it and see what happens over there with the yuan. But I want to shift to the U.S. because we have a potential rate hike in play for the month of December. And in the wake of Chairwoman Yellen's appearance on the Hill a couple of weeks ago, more and more people have been saying that December is it. About 92%, as you mentioned recently, 92% of economists polled by the Wall Street Journal say they believe it is going to happen. And despite that very high percentage, you're really not convinced that that will be the outcome, that it will indeed happen. Tell me about that. Why is that the case?
Well, we've seen these high probabilities for a Fed rate hike all year long, so this is nothing new. Several months before the Fed is supposed to raise rates, everybody believes they're about to do it. And then something generally happens between then and the time the Fed is supposed to pull the trigger, and then the Fed has an excuse why they don't move. And if you look at the economic data that has come out recently, again, it's all been bad. Other than that better than expected jobs number that we got, all the rest of the economic data has pretty much been worse than expected. And how do we know what the revisions are going to be to that jobs report? I mean, these numbers are notoriously revised, and so it may not be as good as it was originally reported. We still are going to get the November jobs number that comes out in early December. That may be bad. And so there's a lot of news that could come out. And of course, the jobs numbers are backward looking, right? A recession doesn't start because of layoffs. Layoffs typically result from a recession. And all of the other economic data points are flashing recession. So it doesn't make any sense that the Fed is going to be looking in the rearview mirror to try to formulate monetary policy and ignoring everything they see in the windshield. So I still think that the Fed is more likely going to punt again, not raise interest rates. Maybe they'll even blame it on the terrorist events happening in Europe. That may allow them to pretend that their decision has nothing to do with the U.S. economy, and maybe people will buy it again. But with the dollar rallying, commodity prices falling, the Fed has another reason to say, well, inflation's still too low. We don't have our inflation goal. And so they can easily get away without raising rates in December.
Yeah, I just want to mention that stellar jobs report, at least stellar in comparison to previous months. 271,000 jobs added, baseline unemployment down to 5%, wage growth accelerating. Also, U.S. consumer prices, as we learned today, in fact, increasing in the month of October after 2 months of decline, showing potential signs of inflation, gradual inflation here. So you think in the midst of everything else, this is really small potatoes?
Yeah, well, first of all, we had the producer prices that came out the other day were quite weak, number one. But look at the retail sales. Look at Macy's, look at Nordstrom's, even Urban Outfitters now today. Walmart's numbers have been weak. I mean, all the big retailers, the Gap. I mean, if consumers have money, why aren't they shopping? If people are getting jobs, why don't they have to spruce up their wardrobes to go along with their new jobs? I mean, the consumer is struggling. That's obvious. He's buried under a mountain of debt. The jobs that we are creating are low-paying, part-time. About 45,000 of the jobs that were created in October were temporary jobs. These are jobs for the holiday season, and probably the retailers are hiring more people than they need, judging by the sales numbers. And again, of these jobs, and it really wasn't stellar, it was barely above the average that we created last year. It wasn't a big report. It was only good compared to the recent reports. You know, this report followed the 2 weakest job reports back to back of the entire year. So it only looked good because the bar had been lowered so much on what would be considered good. But these are all service sector jobs. We lost manufacturing, we lost mining, we lost transportation, we lost forestry, we lost the higher paying jobs. And what do we get? You know, more waiters, more bartenders, you know, more part-time jobs. You cannot build an economy on these low-paying service sector part-time jobs. And that's what all the other economic data is telling us.
Right. So you're saying we're not getting the kinds of jobs that we need at this point. Now, you mentioned retail sales.
And the labor force participation is still at the lowest it's been of this entire so-called recovery.
Right. So I want to dig into retail sales here because you brought it up. Bad earnings out of top department stores, Macy's, Nordstrom's, others, as you mentioned. What's going on here? I mean, for you, you know, what do you attribute that to?
Well, I think the consumer is broke. I mean, you know, the expression is shop till you drop. Well, apparently, I think a lot of Americans have dropped. They don't have the wherewithal. They can't borrow any more money to go out and buy more stuff that they can't afford and really don't need. So I think that's what you're starting to see across the retail space. And it's, you know, low end, mid end, upper end of the market. People are just not shopping the way they were.